In 2008, a man in Florida misses a mortgage payment. 3 weeks later, a factory worker in Germany loses his job. A month after that, a government in Iceland collapses. None of these people know each other. They never met. They never traded anything. And yet, one small crack spread across the entire world. That's not a metaphor. That's how modern economic crises actually work. And once you see the mechanism, it's uncomfortable how fragile everything feels. Because the real question isn't why crises happen. It's why they travel faster than viruses, and why no country is ever really isolated. Setup, why this matters now. Right now, governments are carrying record debt. Banks are more connected than ever. Money moves at the speed of software. Every country says the same thing before a crisis. This time is different. It never is. Understanding how crises spread isn't about predicting the next crash. It's about seeing the invisible wiring of the global economy, the part most people never see, the part that turns local problems into global emergencies. On paper, the global economy looks neat. Each country has its own currency, its own banks, its own laws, its own central bank. If something goes wrong in one place, the damage should stay there, like a house fire. Bad but contained. That's the story we're told. But that's not the system we built. The real system doesn't care about borders. The first hidden connector, banks. Let's start with banks. Banks don't just lend to people. They lend to each other, constantly, across borders, in massive amounts. A French bank might lend billions to a Spanish bank. That Spanish bank might owe money to a German bank. That German bank might rely on funding from the US. It's not a chain. It's a web, and webs don't break cleanly. When one bank starts wobbling, every bank connected to it gets nervous. And nervous banks do one thing very fast. They pull back. They stop lending. They demand cash. They protect themselves. That reaction is rational and catastrophic. The speed problem. Here's where speed matters. In the past, money moved slowly. Ships, paper, delays. Today, money moves in milliseconds. When fear hits, capital doesn't walk out of a country. It vanishes. Trillions of dollars can exit markets, faster than governments can even respond. By the time leaders hold a press conference, the damage is already done. Quiet irony. Politicians like to say markets are emotional. They're right. But the emotion isn't panic. It's self-preservation. Second connector, debt. Now let's talk about debt. Governments borrow from investors. Investors include banks, pension funds, insurance companies, and other countries. When one country looks risky, investors don't just sell that country's debt. They start asking a dangerous question. Who looks similar? If Greece looks unstable, investors look at Italy, then Spain, then Portugal. Not because those countries are identical, but because fear simplifies. In a crisis, nuance dies. Risk gets painted with a wide brush. Interest rates rise. Borrowing becomes harder. Budgets tighten. Suddenly, countries that were fine last year are fighting to survive this year. Not because they changed, but because perception did. Uncomfortable math. Here's the part no one likes to admit. Most countries can survive high debt. They cannot survive high interest rates. A small increase in borrowing costs can explode budgets. Debt that was manageable becomes unpayable. Not over decades, over months. That's how a confidence problem turns into a solvency crisis. Third connector, currencies. Now add currencies to the mix. When investors get scared, they rush into safe currencies. The dollar, sometimes the euro, sometimes the yen. That means other currencies fall. When a currency falls, imports become expensive. Energy, food, medicine, inflation rises. Central banks raise rates to defend the currency, which slows the economy, which scares investors more. This is not bad policy. It's a trap. Once you're in it, every move hurts. Short pause. And remember, this can all start somewhere else. Fourth connector, trade. Countries don't just share money. They share supply chains. If one economy slows, it buys less from others. Exports fall, factories cut hours, jobs disappear. Even countries with strong fundamentals feel the shock. Because demand doesn't respect national pride. The 2008 lesson. In 2008, the crisis didn't spread because every country made the same mistake. It spread because everyone was connected to the same machine. American mortgages were sliced into financial products. Those products were sold globally, rated as safe, insured, leveraged. When the foundation cracked, no one knew where the risk actually was. Banks stopped trusting each other. And when trust disappears from finance, nothing works. not lending, not trade, not growth, contrast, hype versus reality. We like to believe crises spread because of bad actors, greedy bankers, irresponsible governments. Sometimes that's true, but more often, crises spread because the system is designed for efficiency, not resilience. Efficiency removes buffers. Resilience needs them. We optimize the world for speed and profit, and speed is unforgiving when something goes wrong. Zooming out. Here's the bigger risk. Every crisis teaches institutions how to contain the last crisis. New regulations, new safeguards, new stress tests. But the system evolves faster than the rules. Connections grow deeper. Financial products grow more complex. Capital grows more mobile. The next crisis never looks like the previous one. It arrives through a door we weren't watching. Quiet humor. Financial history is basically a long list of people saying, "We didn't think it would happen that way." So when you hear that a small country is in trouble, or a bank you've never heard of is failing, or a currency is suddenly collapsing, the question isn't, does this matter to me? The question is, who is connected to this and how fast can fear move? Because in a global system, distance doesn't protect you. Connection defines you, ending unresolved. And that leaves us with an uncomfortable thought. We've built an economy where crises don't need permission to spread. They just need a pathway. So the real question isn't whether another global crisis will happen. It's whether we've made the web so tight that when the next strand snaps, there's nowhere left for the shock to go.